What's up, edge traders? This is Adam Winnig here today with an interesting video. There is one very simple thing that you can do that will give you 300% higher likelihood of being a profitable Forex trader. It's so easy. It's so simple. It's going to blow your mind. And this isn't just some theory. I'm going to back everything up with stats and numbers and real experiments to show you how this one simple tweak to your Forex trading could give you a 300% higher chance of being a profitable Forex trader. Make sure that you watch this and you watch it till the end, because I've got some really important stuff to share with you. To make your trading elf easy, lucrative, and fun, go ahead and click the like button and smash the subscribe button as well. Now, with that being said, in this video, we're going to talk about one simple, tiny little tweak that you can make to your Forex trading that can give you a 300% higher chance of becoming a successful Forex trader. Now, let me explain what this actually is, okay? So this is fascinating. So we pulled in data from over 43 million different retail trades. And what we found in this data was that Forex traders, retail Forex traders, actually have the foresight to predict the direction that the market's going greater than 61% of the time. That means that out of these 43 million trades, 61% of the times they were actually winning trades. And so retail Forex traders actually have the ability more often than not to actually predict which way the price is going to go, more or less, or at least they have a high win to loss ratio. However, the problem with this statistic is that 95% of retail Forex traders are still net losers. So why is this? If they can predict which way the market's going to go 61% of the time, yet they're 95% of the time they're unprofitable, how is this possible? What's going on there? And it has something to do with the risk to reward ratio. I'm going to pull in some interesting data for you in just a second. But if you look at those same 43 million trades from retail Forex traders, you can see that the losses were 70% bigger than the wins. So the average losing trade was 83 pips, while the average winning trade was only 48 pips. So again, let's take a look at this graph here of the 61% win rate. You can see on euro dollar here, for example, a 61% win rate. However, if you look at euro dollar here again, you can see that the average losing trade again is 83 pips and the average winning trade is only 48 pips. And this has absolutely everything to do with what can make the difference in you becoming a profitable Forex trader. Now, let me show you this really quickly. Okay, so here is the data. Again, this was from 43 million retail trades over a given period of time. And according to our data, this red bar represents if somebody had a negative risk to reward ratio, meaning less than a 1-to-1 risk to reward ratio. And the blue bar shows traders that had a greater than 1-to-1 risk to reward ratio, and it showed their profitability over time. According to these 43 million retail trades, our data shows that 53% of all accounts that operated on at least a 1-to-1 risk to reward ratio turned a net profit in a 12-month sample period. In those who operated under a 1-to-1 risk to reward ratio, a mere 17%. From 17% to 53% simply by using a 1-to-1 risk to reward ratio. This is massive. This will have more to do with your Forex trading success than what your entry is, or, than a lot of things that a lot of people obsess about, but they don't get this part right. In fact, you're more than 3 times more likely to be a profitable Forex trader if you simply use a mere 1-to-1 risk to reward ratio. So take a look at this study, okay? This was a study that was done on a simple RSI trading strategy that is taught to a lot of new retail Forex traders, trading USD CHF on the 1-hour time frame. And basically you see 2 graphs here. You see a red and a blue line graph here, which is plotting the equity curve. The blue line basically shows the way that most people would trade it, with raw stops, where they don't really have set stop losses and take profits. They're kind of just doing it based off of feel, okay? This is how most retail traders trade. And then the red actually has fixed stop limits, fixed take profits, and fixed stop loss points. Now, with the raw, again, the way that most people trade, basically it showed that they had a 65% win rate. So it's very similar to the data that we saw earlier on euro dollar, where we saw that the herd predicted a winning trade 61% of the time. In this scenario, they predicted a winning trade 65% of the time. However, their losses were $200 and their wins were only $121. Okay, again, they have a poor risk to reward ratio. Now, simply doing the same exact experiment, same entry criteria and everything, but just having a fixed stop loss and a fixed take profit. The stop loss was fixed at 115 pips and the take profit was fixed at 120 pips. So it's just slightly over a 1-to-1 risk to reward ratio, but look at the difference in how much more profitable it was. And even though it had a lower winning percentage, it only had a 56% winning percentage compared to a 65% winning percentage, look at how much more profitable the red line is than the blue line, okay? So it just goes to show you that using a 1-to-1 risk to reward ratio and using any sort of entry criteria, you're gonna be a lot more profitable, a lot higher likelihood of being profitable than if you don't. And not only is the likelihood of being more profitable there, but also if you look in the red line that used stop limits or stop loss and take profit, not only did they have better results, but they actually had lower drawdown too and a more stable rising equity curve. Okay, and by the way, if this stuff is interesting for you, this is all stuff inside of our book, Edge Trading Secrets, How to Leave the Herd and Start Trading Like the Smart Money. You can download it for free on our website at www.bluedgefinancial.com. Now, you can also take a look here at the return that was made over this system, testing a bunch of different risk to reward ratios. So here you can see a negative risk to reward ratio, meaning that they're risking 1 in order to earn 0.5. So think of this as like we're risking 1% of our account in order to earn 0.5%. You can see the profitability here. Here's where we saw a 1-to-1 risk to reward ratio. We saw a huge spike in profitability just having a 1-to-1 risk to reward ratio. And then you can see it's kind of evened off. And here at a 1 to 1.5 risk to reward ratio had a really, really awesome spike in profitability. And then it kind of evened off over here towards the end. So the idea here is simply having a 1-to-1 risk to reward ratio. But if it's so easy to just have a 1-to-1 or 1-to-2 or 1-to-3 risk to reward ratio, why can't most people do this? And this little test is going to be really interesting for your psychology. And it's going to teach you a lot about Forex trading. So with that being said, scenario 1, and I'm going to have you pause the video in just a second, but scenario 1, you have the option of either choosing coin A or choosing coin B, okay? When I flip coin A, if it's heads, that means that you're going to earn $1,000, okay? If it flips tails, then you're going to earn $0, okay? $1,000 for heads, $0 for tails. Or option B, if I flip a heads, you earn $450. If I flip a tails, you also win $450. So either way on coin B, either it's heads or tails, you're going to earn $450. With coin A, only if it's heads, you earn $1,000. So which one are you going to pick? Okay, so I want you to pause the video and I want you to actually think about this and actually do this because this is going to be an interesting test on your psychology. Most people are going to pick B, right? Either way, if I flip it heads or I flip it tails, you're going to get $450, right? Okay, let's do another scenario. Okay, and then I'm going to show you the results of this. Scenario A, if it's heads, you lose $1,000, and if it's tails, you lose $0. Or scenario B, okay, which is if it's heads, you lose $450. If it's tails, you also lose $450. Okay, so either way you flip it, you're going to basically lose $450. Okay, most people will go ahead and gamble and take the chance on coin A, right? Because there's a chance that you don't lose any money, right? With B, you're guaranteed to lose money, right? So go ahead and pause this. On scenario 1, what do you pick, A or B? And on scenario 2, what do you pick, A or B? Okay, don't come back to this video until you've actually selected. So let's actually talk about this because this is the reason why it's so difficult for people to have a 1-to-1 risk to reward ratio. And the reason being of why it's so hard to let your profits run and cut your losses shorts is because losses hurt more psychologically than gains give you pleasure. Okay, and there's this thing called the prospect theory. It basically says that losses hurt more psychologically. So we're gonna basically do everything we can to not have to lose as much. But the real way that you need to think if you want to become a successful trader is you don't want to think emotionally. You have to think in the terms of expectancy, okay? Which basically means what are you expected to make on your system per trade that you make, okay? And it's calculated just like this: the probability of a win times your average win minus the probability of your loss times the average loss, okay? So in this scenario with coin A and coin B, where you either win $1,000 if it's heads or win nothing if it's tails, okay, the probability of this system, right, is $500. Well, the probability of choice B, which is what most people choose, they automatically win $450. It's only $450, right? So you can see how just in this little experiment, most of us are not taught to think like traders. We're not taught to think in terms of expectancy. And this is why it's difficult sometimes to have a 1-to-1 or 1-to-2 or 1-to-3 risk to reward ratio, it becomes very challenging. Now let's look at the other scenario, okay? Remember the one where if it was heads, you lost $1,000, if it was tails, you lost nothing? Or option B, if it was heads, you lost 450, and if it was tails, you lost 450? Well, the interesting thing is most people would gamble on this, and they'd be willing to say, hey, there's a possibility that I lose nothing, or I'm willing to take that chance that I could lose nothing or I could lose $1,000. However, if you look at the expectancy here, it's really, really interesting. Choice A has an expectancy of negative $500, even though that's what most people would choose, and choice B has an expectancy of negative $450, which is not what most people would choose, because either way you flip it, you're losing money. So interesting. This is why it's so difficult to have a 1-to-1 risk to reward ratio, but you see the power in having a 1-to-1 risk to reward ratio. According to our data, you're 3 times more likely to be a profitable Forex trader simply using a 1-to-1 risk to reward ratio. Now, at this point, I'm sure that you're pretty far sold into the idea that, yes, you need to have a 1-to-1 risk to reward ratio, but you may be still wondering, well, I still need an edge in the market, or I still need a Forex strategy that can actually work long-term and can be robust. So I created this video here, one of our favorite Forex strategies that uses greater than a 1-to-1 risk to reward ratio. And I'll explain exactly how it works. So go ahead and watch that video right now.